All right, so what we're going to do today is we're going to tackle the zero DTE side of trading and the option strategies that you can use to really handle the day-to-day day trading side of all of this. What we're going to be doing is going to be doing strangles and iron condors. Now, if you're unfamiliar with any of those terms or just any of this in general, a strangle is going to be selling some out-the-money calls, an out-the-money put, and an iron condor is going to be the exact same thing, selling an out-the-money call, out-the-money put, and also capping those to your risk tolerance of however much you want to risk to make a little bit less, but also control the risk side of things of how much you can lose. So what we have here and what you're going to be seeing on your screen is I highlighted the most important parts of the strategy that you need to see this video, walk away from it, and put it into action. So let's just break it down from what it is, okay? All right, so every 3 days, you have Monday, Wednesday, Friday, you have zero DTE option contracts that you can trade on SPX SPY, just a handful of other names whatsoever. What you're going to be doing here is you're going to be looking for way out the money calls and puts, and you're going to be selling those, selling them to open. So what we have here on this one, this is just a mock trade. This has nothing to do with an actual trade, nothing you should follow. It's just how you would generally look at it and set it up based off of delta alone. All right, so this one is going to be for June 1st, 2021, depending on when you're watching this video, and you're going to be targeting the nearest and closest to 15 delta and under that you have. So the reason why I created box on this from 15 to 5 is based off of strength. We'll get into that later, but I wanted to show you what you could do. So based off of, if I'm going to sell a 15 delta 4170 put, and I'm going to be selling a 17 delta call, because that's the nearest thing to 15 right now that we have, and a 4230. Right now, if I wanted to do that, and I'm playing off of the implied move that I had, the implied move is going to be all the way to your right, sitting at a 21. So 21 off the current price is going to be, let's make it simple, depending on when you view this, 4,200 plus 20 minus 20 off of that. So it plays right off of that 15 delta, but it's going to be slightly off and out of that 15 delta, which means you have a higher probability of that happening. So if you were just to take right outside that 15 delta, outside the implied move, you're going to be picking up a credit of right here. This is just assuming that this is what it was at open market. You can get in here. Let's just put it at $500 credit. Now that leaves you open and exposed to, if it goes beyond your strikes and way beyond your strikes, there's a lot of risk that's involved. But there's a lot of people that do sell naked out there like that. And that's okay. That's what it's about in defining your risk tolerance. So then I also highlighted the other aspect of this for the bare minimum side of people that will take that exact same trade, the 4230 on the call side, the 4170 on the put side, but also capping it to the smallest percentage and risk tolerance that you could possibly have on there by the next available strike in the 4235 and the 4165s. By buying those to cap it, which means that if it did go beyond those, the maximum that you could possibly lose is you take 500 because the length of the strike, then minus your credit, so it's going to be 105. So the maximum that you're going to be losing on this trade right here is about 395. You're still walking away with $100, still playing off of the implied move, still playing off of the probability that it won't exceed those ranges. And then you can start adding size to confidence levels when it comes to this. So, you know, you're saying, what's $100? What am I going to do with that? Who cares? All right. But when you start adding that up, you know, you're risking $500 to make that $100 off a really good chance of making that money. So it's not 100% certain, but it's greater than 50, which is an edge. All right. Then you can add more contracts. All right. You can add the 2 lots, you can add the 5 lots, 10 lots. And all of a sudden you're making $500 potentially per 3 days a week, $1,500 a week. You're looking at $50,000 a year. That's if every single trade possibly works, which obviously won't happen. So let's not cloud our heads with that. But the risk management side of things is what makes this possible. All right. So you're saying to yourself, well, why? That's the absolute 15 delta for everything. I'm not going to be taking that every single time. And you're absolutely right. So I highlighted boxes all the way down to the 5 delta. All right. And you're probably saying to yourself, what would make me take a lower delta? Well, it's going to be the strength of the day, all right? And there's a way that you can do the strength of the day, and you'll see it right here on your screen. It's going to be add, all right? It's the most basic form of just calculating and determining the day based off of advanced decline. All right. So if it's above a certain level, all right, you're going to be maybe only taking the call side of things. If it's below a certain level, maybe you're only taking the put side of things. Or maybe if it's right in the middle and you feel really confident because the majority of the time when it's between these levels, you have a higher percentage of an iron condor working or a straddle, or a strangle working. You feel really confident in taking that, and that's when you can move directionally based off of these inside these boxes on these deltas from I'm super confident I'm taking a 15 delta to maybe I'm really not that confident in my day, I'll take a 5 delta. All right. Now, you're going to be making significantly less. You're not going to be making $100 if you drop down to a 5 delta, but you'll be making something that's considered higher probability. It's not easy money. It's just considered higher probability. All right. If somebody gets you an 80% chance to win money on a scratch-off ticket, the chances are majority of everybody, whoever gets that scratch-off ticket, is going to take that. So that's where we're going to dive into the next side of things, is risk management. All right. So what's the way that you can think of off the top of your head that you're running these strategies so that ultimately one trade doesn't blow up your account? Okay, you're going to start thinking about, well, I need stops in place. Okay, well, what are those stops? What are those stops that you need in place in order to make sure that this strategy succeeds? All right, number one, no overnight exposure, because you can't control anything overnight. So in order to make sure that you don't put on a 1 DTE, 1 day till expiration, so trying to get a little jump start on things and making sure you're getting in on a Thursday, making sure you're getting on maybe a Tuesday, or making sure you're going to hold over the weekend, which is, that's tough. So what you're going to be doing is making sure you're opening this and you have all time throughout the day to make adjustments, manage your stops, and then making sure that no outlier events happen. And if an outlier event does happen, you know what? There's a probably good chance that a lot of people get messed up that day. And you were following a strategy that will potentially, over the course of weeks, months, years, will provide the results that you want. And outlier events will not destroy that day, because you're going to get out with maybe not at the right time that you want to get out, but it's not going to be an exploding account day. All right. Unless, the world gets nuked and, the stock market crashes and you got nuked and your account is left open during that time. Maybe that's how it can happen, but not here. All right. So what's the appropriate way that you can manage risk on here? So one of the things that I teach and I tell people what you should do is when you run these credit spreads and you run them on a 0 DTE basis, you need to think of in terms of when can I get my money back if I ran this again? So we're thinking 2 times credit. If a 2 times credit stop on these plays. So right now I'm going to be collecting on your screen right here. It's going to be just a plain old strangle on this. So if I'm going to be making $500 on that, 2 times credit means that the second that gets to 10 instead of 5, that's 2 times. That's my stop. But because if I walk into the next day on a Wednesday and I can get a $5 credit on that as well, I made up my loss. It's a good probability that it happens and I'll get that money back. All right. And then, so it's 1 day to recoup. And that's the same thing with the iron condor. So right here, I'm at let's put it even, $100 credit on this. All right. So my 2 times credit stop is when that spread, that contract that I put open, is going to hit $2 on that. All right. That's your 2 times credit stop. So that if Wednesday rolls around and I can get another $100, same spread, everything opened up, I can then make that back instantly and I recoup my losses. I have a 1 day stop period between taking a loss on the trade and making that money back. Now you can take the riskier side of things where things just seem to be moving well too fast, too much forward, too much down, whatever you think it is, and you think that if you just can give it a little bit more time, it'll pull back into range and you'll get that money. So then that's when the 3 times credit comes involved, which seems really simple and stupid. And you're thinking to yourself, yeah, you're just going to keep increasing this value every single time. But why are we doing 3 times? Because then by the end of the week, because of these trades typically have a higher percentage chance to work, and it's statistically proven because they're so far out the money, all right, they're low in delta, which means there's a good chance they don't hit. They're being priced accordingly for that. If you have above a 60% chance that it works, that means they're not going to hit that often. All right, so if you take a 3 times credit on that, so 3 times 15 on the strangle and 3 times on the 100, 300 on the stop on the iron condor. Those are ways that you can continue to, you can make that back by the end of the week, because one day didn't happen. By Wednesday, by Friday, you eventually make that money back, and eventually that makes you to a break even on the week. But the chances are, over the course of time, weeks, over months, over years, you won't have that. You won't be at break even at the end of the year. You'll be making this passive little income. And I know that's taboo in this world, but we showed this for months on end. Every single day we showed the movement of these contracts, how you can play to it. If you would get stopped out, what does it look like to hold into there? And this will move into other aspects of our strategies. We'll talk about the iron flies. We'll talk about the line in the sand trades. We'll be talking about a bunch of different strategies you can use. But this one's really simple. All right, you base it off of strength. All right, add is add really high? Is it over 1,000? Great. You shouldn't be looking for a 15 delta. You should probably be looking a little lower, maybe under 10, maybe even 5, just to be safe. All right, if add is really low and it's still hanging under 500 plus or minus, go ahead and grab that 15. All right, the chances are throughout history, over the course of decades, that 15 doesn't hit and you make your money off of that. So that's ways that you can play off of that. And you're looking at just a couple things here. You're looking at vol, you're looking at delta, you're looking at the price that you would get for this, and then you're just managing based off of a simple dynamic of, you're going to put a stop at 2 times or 3 times based off of what your gut says. It's your risk tolerance, what you're willing to do, but never go beyond 3, because then you need an extra week in order to make your money back. And you have to stick to those rules, no matter how many weeks that doesn't hit, or how many weeks you just don't make it back, or maybe it hits on a Monday and maybe Wednesday it hits again. You know what? But over the course of the next couple weeks, the chances are that that really doesn't hit. Okay, it's really simple. We'll dive into the iron fly next, which is really simple. Again, a straddle, and then we'll be talking about the different ways to cap it and move it. All right. So just a quick recap again. You're looking at these things the morning of them happening, never overnight. You never want overnight exposure, because it's things you can't handle. You can't get out of a contract, or you can't get out of all these contracts at 3 a.m. in the morning on SPX SPY. You have to wait until the open. All right, so that's one way to limit it. Keep those stops in place, manage this intraday, and you'll be good.